So we have a trading range, and this seems to be the top of the range, and the market is reversing up from the bottom and coming this way. So if this is a trading range with, a high and a low, odds are it's going to stay in this environment, because a trading range is an environment of reversals. It's the opposite of the trend. So market inertia keeps the market in this kind of environment. But the legs up and down in trading ranges are really strong. So they rush to the top and they rush to the bottom and reverse. The problem with trading them is the psychology of trading them, because they're so strong that you think that, okay, this is the precursor of a breakout. And sometimes there are no hesitations in them until they get quite close to the resistance line. And then there is a hesitation bar here, and then there is a high one. The high one is so close to the top of the range that if you buy, you're probably not going to make money. The problem is really the psychology, because at this point, you look at this strength and say, oh my gosh, it can go up here. Yes, it can, but it's not likely, because if the market is in a trading range, moves are vacuum moves. They're not really driven by volume or consistent buying or consistent selling. It's like no selling here until it gets up there, and then bears start to short. So the lack of selling in this middle of the range makes the market get absorbed up to the resistance level. And the opposite happens for the bear leg, exactly in the same manner. The better trade is to look for this high one. And, if you look at the charts, the high ones are usually bad. Like there's something wrong with them. They don't look like the strong versions. So the higher probability trade, which is actually about 80% probability, is to place a limit order here. So there's a limit order here to short where the bulls are buying. So an inexperienced trader looks at this and says, okay, this is a strong leg up. Here's a high one. I want to buy with a stop order here. The experienced trader looks at this and says, good luck. This is a trading range day. There's 80% chance of a failure. So you are taking the 20% probability, the low probability trade by buying a stop here. I'm taking the higher probability trade, which is a limit order short. I am going to sell to you. The market goes up, hits this, and then reverses, goes all the way here, down to there. And as it is approaching here, there is a bear bar, usually with a tail. And then there is a pullback, and the pullback fails, and you get a low one short here. So the beginner lost here looks at this and says, okay, so bulls failed. This looks like a bear trend. It's very strong. And here's my low one short. I'm going to short here. But then the experienced trader says, good luck with that. You just have about 80% chance of getting a bear breakout. So I'm going to buy here. I'm going to buy from you with a limit order. I think that this is going to get triggered and reversed up, and the market is going to go up there again. So this is how it looks as a schematic. Now, if it is a low 2 or a high 2, you just have 2 of these legs. So it looks like this and goes a little bit higher, and there's a second reversal bar here, and that's a low 2 or double top bear flag. But it fails. It fails exactly in the same manner. So the limit order bulls, they put a limit order here. They expect this to get triggered because it's the second reversal. And they will buy here, and they will buy below the range as well. So order 1, order 2, scale in here. And the bet is the market is going to move to this middle 1/3. So eventually, odds are both of these entries are going to be successful, and the market's going to test the middle of the range. So these buyers here are fairly aggressive because they know the math. For example, I think on the 17th, I'm not sure, I don't remember it exactly, but I think 17th was the legs were good, but they also had pullbacks along the way. That's what I remember from. Let's take a look. I'm not sure. So I think on 17th, I sold above this tail, as far as I remember. And I guess I also sold above this tail, this high close. Actually, I think, or maybe I bought here. I don't remember honestly, but I think there was an exit or something here.
I'm pretty sure you bought the 30 low.
Yes, because this is too strong. And then this looks like a short in here. A buy here and a sell there, or don't buy here but sell there. Then I think this looks like a wedge test, so dwelling line reversal, and then this is a bad buy. This is a high one near the top of the range, and you want to sell here. On the bottom, so if you look at this leg, so 1, 2, 3, that's a low one short. I didn't go to a new low, so this could be a low 2, but this is bad. There's probably a buy below this bar. I don't think I was buying at that point, but I think had I been flat and not short, it made sense to buy below this low. But it also, the better trade in this is just selling after 4 bars down, selling the first test up. So this is a better trade between these two. This is higher probability, but this is also reasonable. Also, coming down here, you have this could be part of the leg up, so not very reliable, but this is a reset. So 1, 2, and 3. So you have 3 legs down, and then you have a low one short. There's a buy below 45.
So Ali, for that one, for the buy below 45, I think it's on the list, but now the trading range has kind of shifted from the entire range from bar 1 to bar 11 high, and now that low one is coming in a smaller upper range. So
doesn't matter.
Is that,
look at the day, right?
Right.
The day is a gap up day and the market is accepting the gap. So there's breakout, follow through, follow through. 2 bull bars on the open. It's lower probability for this to become a bear trend. And because this is about 80% of the daily range, it's unlikely that the market goes up another 80%. So most likely this is going to become a trading range day, but no evidence for it until you get all of this. When you get 4 bars in a row, this is not in line with a bull trend structure. This is in line with bear trend or trading range. But we know that the odds of a bear trend is low, so probably trading range day. But the day has a bullish tone. This is the opposite of that other day which had a bear triangle. This is mostly bullish. So if it is mostly bullish, bulls should be more successful, which means the market might not get down here. Once you get 3 legs in one direction and then a resumption in an overall bullish environment, that is good enough. I mean, you don't have to wait for it to get up there. You know, that is why I said, let me draw it for you first, because this is theoretical, but you have to adjust it based on what you see. And what you see is a bullish context. So this bullish context comes first. Everything else should be seen in the light of this context. And what do you see? You see, up to this point, bears were doing great, 4 bars at a time. That's fantastic. But then 1, 2, 3, 4, 5, 6, 7 bull bodies. This is a reset. Then you have 2 bars down, 3 bars up, 2 bars down, 2 bars up, 2 bars down, 2 bars up. So the cycle of the market is changing from longer micro channels to fairly small micro channels around noontime. And you have multiple reversals. Can this get a big bear bar here? Yeah, sure, everything's possible, but that's lower probability. The day is mostly bullish and the gaps are still open. These bodies are not touching these bodies. So odds are this is going to go sideways to up rather than sideways to down. That's how you adjust it. You adjust it based on what kind of breakouts you see, what kind of gaps are open, how the open of the day form, who is more in control. Those things changes the expectations and prices that you would place your orders to enter the market. This might not get down there because of all of this bullishness. These 2 days are actually quite interesting because they look like, you know, brothers and sisters. They're opposite, but they're also very related. Let's find some better examples because triangles are not really great for that. What about this day? This is more rectangular in this part. Yeah, so this is another example of a low one near the low of the day. You see how strong this leg is? It looks like a new breakout, but it's a vacuum test of the bottom. It goes sideways and then reverses. Buying below 68 is still quite aggressive because this can drop to this moving average. There's too much energy in it. But it is also reasonable because if you diagnose this as a trading range day with an overall bullish tone because of the gap up and these many strong bull bars, then it makes sense. So this becomes sort of a leg 2 trap and then a reversal. The other way of handling it is to just wait for a double bottom. That's bar 70. This one has a tail, so not ideal. After 4 bars down, you see these highs are trending. But then you get another bar that closes far above this high. So you have a failure plus a second failure, and the second failure also breaks out and closes above this high. It was okay to sell the high of this bear bar. This might be the test target, and you get that pullback and then trend resumption. So limit order is to buy within the range of bar 71 based on the side mirror or just based on looking at these prior bars. Buying the close of bar 71 is dangerous because it's so close to the moving average. You might not get a chance to take profits. This was a lucky break for the bulls. Stop order above 70 is not great, but it is reasonable because it's at the bottom of a trading range. So this is the lower probability trade. This is both of these, limit order here, market order here. Both of them are a bit dangerous. And buying with a limit order when market tests the prior highs, where bears sold with limit orders, is the best one. But if you wait for it to happen, you might actually miss the trade. It's never exactly what we want, so you have to settle for one of these options and then rely on your stuff.